Intermediate Accounting, Long-Term Debt. This is Ken Boyd, the owner of St. Louis Test Preparation, and here's our email address and our phone number. The source for this video is from the Keystone Wygant. The text has been around many years. The publisher's website, wally.com, has a lot of great information that you can use. We're going to talk about one aspect of long-term debt, and it's a bond indenture, and an indenture is another name for a contract. You own a business and you don't have enough cash in your business to expand, operate, whatever the need might be. So you're going to get some capital for your business. And as I've always said, there's two ways you can raise money to run your business. One is equity. You sell ownership. You get cash in exchange for ownership. The way we're talking about today is debt. Instead of the other person giving you money being a creditor, the other person being an owner, the person you're dealing with is a creditor. You get cash in exchange for a promise to pay them back. And that goes to our second bullet point here, which is, you may remember if you took business law, the definition of a negotiable instrument. And part of that definition is, in business law, a promise to pay. A bond indenture is a promise to pay a sum certain by a certain date. So it's really a contract. I've gone over to Excel here, and you'll see that I have bond indenture contract, and the reason is to obtain capital for business. So let's go back to our example that we have 1,000. This is what I have pictured here is the actual bond certificate. It's a $1,000 bond issued by IBM Corporation. Pays 7% a year for 10 years, and it's due to be paid back December 15th, 2019. That promise to pay a sum certain, if we're a little more specific on that sum, we're going to pay interest. We, the issuer, are going to pay interest to the owner, and if it's a corporate bond, it's usually semi-annually. And at maturity, in this case 12/15/2019, we're going to repay the principal. Another name for that is the face amount, the original price of the bond when it was issued. We're going to pay that back to the investor. And so this is part of the contract that we have with them. We have different types of bonds, secured versus unsecured. The comparison I use here is you see commercials here, advertisements for a secured credit card. And a secured credit card is a credit card that's backed by a cash deposit that you make, so that if you don't make payments, the company would have some security, and that security is they would get the cash deposit you made. Versus unsecured, which means the security of your credit card, most credit cards that people have, is only a promise to pay. So it is unsecured. By that I mean unsecured, not backed by a specific asset. So that's why I asked the question here, what do I get? With secured, there is a specific asset backing the borrowing. Unsecured means it's just an unconditional promise to pay. And another type of bond is called a callable bond. If you look at our second example here, we're going to talk about a callable bond. And we define it as a call feature, or a callable bond, is that the issuer, in this case IBM, has a right to repay the investor, in this case Bob Smith, the owner. Pay him back early, and by early I mean before maturity, before December 15th, 2019. And so you can see on my bond certificate here that it's written on the certificate itself that there is a call feature. And specifically, the bond is callable December 15th, 2011, 8 years before maturity, or any time after that date. So that's the call feature that's actually written on the face of the bond certificate, so the investor knows what's going on. The next question is, well, why? Why would an issuer want to pay a bond off early? Let's assume that interest rates decline. So now instead of IBM and companies like it issuing 10-year bonds at 7%, they can now issue 10-year bonds at 6%. Well, obviously that 7% bond is more expensive than the current interest rate environment. This is why we had people refinancing home loans when interest rates go down, because now they can borrow at a cheaper rate. It's all about lowering the cost of borrowing, whether you're a company or a homeowner. So just like the homeowner, when interest rates decline, IBM would like to reissue that debt at a lower interest rate, like refinancing a house. The result is the capital is cheaper since you're issuing at a lower interest rate. They'd prefer the 7%, they'd prefer replacing the 7% bond with the 6%. So let's say that we get to that date, 12/15/2011, and IBM contacts their Bob Smith and the other owners of this bond and says, we are going to exercise our call feature, so Mr. Investor, we are going to pay off this bond early. If you go down here, you see the actual process, what happens when that bond is paid off in terms of debits and credits. First of all, we pay off the old bond its face value, which is $1,000, the amount that it was originally issued at. Now, sometimes a call feature will involve something written in the bond certificate that says if we pay you off early, we actually have to pay you something more than the face amount, the principal. So maybe the call feature might say it's callable on this date, but we have to pay the investor $1,020 rather than just $1,000, to reward them for the fact that they're going to have to reinvest their money at a lower interest rate, and we want to sort of cushion the blow, give them some sort of perk for allowing us to pay them early. But ignoring that, in my example here, I've said we're going to debit the bond payable, the liability. We're going to debit the liability and reduce it. And we, the issuer, IBM, are going to pay cash, so we're going to credit cash $1,000. So we've removed the liability and we've reduced cash. And when we issue the new bond, the reverse happens. We have cash coming in the door, the proceeds from the sale of the 6% bond, and we're going to have a new liability out there for $1,000. So that is a call feature, and it's going to be stated on the face of the bond. That's the end of part 12. We will continue our discussion on bonds and long-term debt in the next video. Our YouTube channel, Ken Boyd STL, all one word. For small group live chats, we do the first Saturday of the month, every month, in a low-cost live chat environment in a small group. We also do one-on-one tutoring and live chat sessions through our website. Here's all of our contact information, and we'll see you next time.